This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from three Canadians. We're hosted by me, Benjamin Felix, Chief Investment Officer at PWL Capital, Dan Bortolotti, Portfolio Manager at PWL Capital, and Mark McGrath, Associate Portfolio Manager at PWL Capital.
Welcome. Big episode.
Yes.
The year-end episode. Today.
Yeah. It could be a long episode. I don't know. We'll see. We'll see how it goes. We're breaking from our usual year-end tradition, which listeners may be familiar with. We mentioned this in a previous episode, but I'll explain quickly now. Instead of taking clips from throughout the year and making a clip episode where we kind of discuss some of the highlights from the year, we instead asked our audience to send us questions. The idea would be kind of like an AMA. We have not prepared. We're just going to go through the questions and answer them as they come. We received in total 161 questions from listeners. So we're not going to get through all of them. We're going to do it. That's why I joked about potentially being a long episode. But we're going to go through as many as we can. And that's going to be the episode. I think it's kind of a neat idea. If it works well, we'll do it again next year. Before we get into that, I do want to say a few year-end thank yous, which is another tradition that we've kept as long as we've been doing the podcast. So I want to thank Matt Gambino, who's actually here with us now, but you can't see him. He's our video producer. He's the guy that makes all of the YouTube content happen. Without him, we would not have that channel and that content. And YouTube has been a big source of growth for the podcast. The audio downloads have been kind of flat this year, but on YouTube, it's continued to grow at a pretty good pace. So that's great to see. And we have Matt to thank for creating that content. I also want to thank the Podcast Consultant. That's the name of their business. They are our audio producers. So all of the audio post-production goes through them. They've been doing our podcast ever since the very beginning. If you want to start a podcast and pay for professional production, they are the place to go. They do a great job. I also have to thank the PWL compliance team. They listen to every single episode before it's published. They jokingly gave us an extra big thanks for the 2-hour Mike Green and Randy Cohen episode. That was like pretty geeky for our compliance team are not necessarily into the geekiest content, so they thanked us for that one, which was funny.
How often does compliance ever flag anything and say, you guys can't say that on the air?
They never do. I don't think we've had anything rejected. Big stuff is like forward-looking promises, right? Like we're gonna get you 12% a year returns.
And the answer is actually 11. Yeah.
Yeah. I think we're pretty tame from a compliance perspective. So they don't give us a hard time. But it's incredible they listen to every single episode before it's released. We appreciate that. Also to thank the marketing team at PWL. They take all of the content and make sure it gets posted in the right places at the right times, which is in itself a big undertaking. They also do all the social media posting on Twitter and Instagram to help promote the podcast and get it into the hands of more people, or the ears of more people. Angelica Montagano in particular, she leads the marketing team, and she's been closely involved with the podcast since the very beginning. Also have to thank all the guests that have joined us this year. Obviously, we appreciate we ask some pretty incredible people to come join us for conversations, and they usually say yes, and they usually dedicate a lot of time both preparing to talk to us and talking to us. I got to thank the moderators in the Rational Reminder community. We have a growing moderation team, volunteer moderators who are people that are highly engaged in the Rational Reminder community, and they really make it what it is. If you compare it to other online forums that discuss investment-related topics, I think our moderation is much heavier than the typical online forum, and I think that's a good thing. And I think the people who are involved in the Rational Reminder community would agree with me, and that's why they're there. So the moderation team does a great job keeping things on track. Also have to thank the listeners. If you're listening, I mean, this is why we're creating content. If nobody listened, it would not be that fun to make a podcast. And I mean, the content in this episode is like all questions from listeners. So that's pretty cool too. And then I'm going to thank you two guys, Dan and Mark, for joining us as new co-hosts this year. It's an exciting evolution of the podcast, and I'm excited to continue building it out with you guys.
Well, and likewise, thank you, Ben, for having us and for all the work you put into it as well.
Yeah, it's really been very enjoyable to kind of get back behind the mic and have this kind of outreach with readers, listeners, viewers, clients, prospects, everybody else. Yeah.
Yeah. Well, you guys are both naturals, and it's a lot of fun making the podcast with you. All right, so I think we can jump into our AMA episode. We have these 161 questions from listeners, and we're just going to start from the very first one. So it's a bit of a first come, first serve, I guess. We will save the questions that we don't answer today for future episodes because we got so many questions. I think that we can probably make an AMA segment maybe for future episodes for a while, at least until we run out of questions. All right. So let's start. The first question that we got came in from Tala, who is a member of the Rash Reminder community. They ask, what was a particularly influential post or discussion in the community that genuinely changed your mind about something? Oh man. So that one's basically on me because I know you guys aren't in there as much. I mean, the discussion with or about Andrew Chen's research and the discussion that followed his episode was really interesting, made you think a lot about just the robustness of data around factors and whether differences in expected returns are really there statistically, and what potentially could not invalidate Andrew's research, but give hope to factor investors despite Andrew's research. I think Andrew's research is valid, but there are still good reasons to believe that tilting toward higher expected return stocks can make sense. That's probably the biggest one. I mean, the discussions about Mike Green stuff and the discussion that followed Mike Green's episode, that was also pretty eye-opening. I mean, I know you guys listened to that episode too, but that discussion in the community around that leading up to that episode and following it was definitely eye-opening just in terms of seeing the different sides of that argument on whether index funds are really having a detrimental effect on financial markets. Those are probably the biggest ones for me.
Yeah. Yeah. Like you said, I don't spend a ton of time in there unless I'm kind of tagged in something. So I'll leave that question with you, Ben.
Yeah. Off the top of my head, those are the two biggest ones. But the discussion there's so good. Like, often pick up ideas and bits and pieces and arguments that maybe haven't seen before. Yeah, off the top of my head, those are the two big ones.
Nice. Are we just going to rotate through the questions then?
Yeah, sure.
Next? Sure. Okay, I'll ask the next one. To all on the podcast, what would an ETF composed in your name consist of? This was an anonymous question. What would an ETF composed in your name consist of? So assuming this is a question around what would that investment strategy look like, I'll let you guys give your thoughts too. But I think honestly, like, so the funds we use for clients are from Dimensional Fund Advisors, and Ben, you said the other day, it's kind of like a big index fund with mild tilts towards some of these factors that we talk about all the time, right?
Yep.
I'm just talking about specifically their 100% equity portfolio, but it's a single fund, global equity. Right now, something like 13,000 global stocks with a bit of Canadian home bias, super low fee, kind of tilted towards small value and profitability. And I mean, there's a reason we use those funds, right? It's exactly kind of what we believe is optimal for most clients. So I think our ETFs would probably be pretty similar to that.
Yep. Dan's answer might be different, but for me, I'd be similar to you, Mark, that I'd mostly market cap weighted, but a bit of a tilt toward sources of higher expected return. I'd keep it super simple, but I would definitely maintain broad diversification, which is why it would be like a super unprofitable ETF for me as the ETF issuer.
Yeah, but that said, I would say that the asset allocation ETFs, the traditional
True.
ones from Vanguard, iShares, BMO, and now even a few other ETF providers are pretty great. I mean, just add a little context to that. I mean, going back, when I first started talking about this stuff 15 years ago, I used to dream of funds like that. And I openly said that, on my blog and in articles that I wrote, if only an ETF provider could just build a balanced index portfolio in a single fund. There is hundreds of billions of dollars in balanced mutual funds, almost all of them actively managed and very expensive. And I was saying if people could just build an ETF with a low cost, diversified index portfolio in one product, that's all anybody really needs. Now, thank goodness, we have many of them. And, people are voting with their money, right? I mean, those asset allocation ETFs have been extremely successful. That's what I was trying to say. They're not extremely expensive.
Yeah.
But I wasn't sure, whether there would be much take up, but I'm very glad to see that they've been very successful. So,
Yep. You could have launched a Canadian couch potato asset allocation ETF, and that would have probably picked up a lot of assets.
I will tell you, the opportunity came up, right? I
Yeah.
mean, we didn't get very far with it, but there was some discussions, and I'm quite glad I didn't do it, but I'm glad that somebody did it and
Yeah.
branded it. Well, didn't brand it, just put it under their own ETF provider name, because the brand isn't what's important, but
Yeah.
certainly have a lot better choices than we did 10 years ago.
Yep. So would that be your ETF if you made an ETF in your name?
Yeah, exactly. Like I would say that I don't, if somebody said to me, can you design the ideal ETF? I would say it's probably already been done. I mean, look, you could argue over little tweaks, but I mean, we're 98% of the way there.
Yeah.
XEQT or VEQT?
So, or it doesn't even need to be VEQT, right? It could be VBAL, VGROW, whatever your asset allocation happens to be. I would say I actually like the Vanguard ones a little bit more than the iShares ones. I think the iShares ones are maybe a little too heavily weighted to US equities, but that's a quibble.
Yep.
And I think either one of them are just fine.
Yep.
Yep. I agree with all that.
Ben,
I
you
put
got
my
to
name
do the next question.
Yeah. You guys can't answer that one.
Nope.
Please explain why Ben decided to shave his head for so long. I mean, it's a pretty boring story, honestly. At a point in time, as now, I'm getting my haircut again at a regular frequency now. But when 10 years ago, I would go and get my haircut every 3 to 4 weeks, kind of like this, like I have it now. And I'd go to this barber shop that was like, I don't know, a 10-minute drive from my house. And I had, I was starting to have kids and it was getting busier and busier, but I would go and get my haircut. And the place I went to took cash only, which is fine. It was like an old school barber shop. It was kind of cool. But there was an ATM in the building that it was in. And so I would just go to the ATM that had no extra fees. I think it was, I used a Tangerine Bank at the time, which is like a low fee bank in Canada. And they were bought by Scotiabank. And so you could use their ATMs with no fees, Scotiabank ATMs. So just Scotiabank ATM. And I'd go and take $20 out, which was enough to pay for the haircut and a tip. And it was easy. And then they raised their prices to a point where it might have been to $20 or something like that, or close to $20. And so to tip, I would have had to have $20 and some change. And I was like, where am I going to get change? Like, this is crazy. And so I went in one time and I paid for my haircut, or I got cash out to pay for my haircut. Or maybe it was the second time. Maybe I went in the first time and I'd like break a second 20 and then I had all this change kicking around. I was like, this is brutal. And then the second time I went back, I told the guy, he starts cutting and I'm thinking like, man, I don't want to do this every few weeks. Like, this is really annoying. And he's like halfway through cutting my hair and he's like, you know what? Just shave it off. And he looks at me with like shocked eyes. He's like, are you sure? So yeah, just shave it down to a no guard. He's like, wow, okay. And he did. And then I left and I stopped at Walmart on the way home and bought clippers and shaved my own head for 10 years. It was very convenient. And then recently decided to stop shaving my head. That's it. That's the story.
That is not the explanation I was expecting. And
No.
It does really beg the question, A, where were you getting haircuts for only $20?
Yeah.
And B, why didn't you just use a credit card?
They didn't know they were cash only.
Oh,
And
okay.
it was like a really old school place. Maybe that's why their prices were so low too. It was in like an old strip mall and super old school. Like they hadn't updated the place in, 30 years or something. And I liked that about it. and they had a bunch of older guys that cut hair, and like you could tell they'd been there for probably decades. And that vibe was cool, but it was cash only. You couldn't pay with a credit card. And that was it. I mean, the inconvenience of having to figure out where to get my extra $2 coin from every few weeks was like, you know what? I'm just not going to do this anymore.
But once you broke that second 20, that's 10. If it's $2 for a tip, that's 10 haircuts with the change that you've already done. Like you only have to break the 20 once every 10 haircuts.
Carrying change around in my wallet, like it's just
you stick it at home in a jar,
much.
and you just go bring it when you go to get your haircut done.
Yeah, I guess.
A little haircut.
I
barber
could have solved the
was
problem
happy.
different ways, Mark, but that's the way I chose to solve it.
Yeah. On the one hand, I'm not surprised. On the other hand, like Dan, I didn't think that was going to be. I thought it was just a pure efficiency thing. Like, I'm busy. This is easier. I can do it at home.
Well, that was part of it too. Then it became like, okay, this is minorly inconvenient, and then I started thinking about it. It would be, for 10 years, I cut my hair once a week, and it took 10 minutes, and it was great.
I just booked a haircut, and it's $40 and it's just a barber, like nothing fancy, and that's before tip. So with tip and tax, you're looking at $50 now.
Yep, mine's about the same now. But the other thing that happened is that, so we moved after that, and I wasn't 10 minutes away anymore, so it became a hassle. And I guess I could have found another place, maybe, I don't know. But now where we live, there's a really great hairdresser that's like a 5-minute walk from my house. So that also played into the decision to start having hair again.
Yeah.
Anyway, enough about hair.
Dan, you want to read the next one?
Yeah, sure. Okay, so our next question. How should individual investors consider their working human capital as an allocation to their overall portfolio? Is there strong evidence to consider diversifying even further from their native currency? For example, a negative tilt away from home country bias. For example, 50% U.S. allocation for U.S. investors. And that question is from Mitchell Layton.
Ben, you want to start with that one? I've got some thoughts, but you go ahead.
Do you want to start with your thoughts?
Sure. Okay. Yeah. Human capital. So, and we talked about this. I don't know if that episode's actually, I don't think it's released yet, or if it will be released by the time of this recording, but we talked about this with a guest recently, and how to kind of integrate human capital into useful financial planning models. And I think it's difficult. Like Moshe Milevsky has a book on this called Are You a Stock or a Bond? And largely talks about the kind of volatility and stability of your income stream, right? So, I mean, if you're I'm just going to use, let's say, a firefighter or a police officer or like a, tenured professor or something like that, it was very, very stable income, a relatively good income, perhaps a pension, workplace benefits, long-term disability and everything else. Your human capital is more bond-like in nature, right? It's a lot more stable. Whereas if you're a sales professional that's, especially in like a cyclical industry, say like a real estate or tech sales or something like that, your human capital is a lot more volatile. So I think you do have to kind of keep it in mind. A lot of this for me comes down to risk capacity and risk tolerance profiling. So we go through an exercise with all of our clients where we look at risk capacity and tolerance and helping to design portfolios. And part of that risk capacity is some of those things I just mentioned. Like, do you have stable income? When do you need to withdraw from the portfolio? Do you have adequate life and disability insurance? So I think there's ways that you can kind of incorporate that into the capacity section of portfolio design. But it's very difficult to say what anybody's, I mean, you can take like the present value of, I guess, of your existing salary with some assumptions over your lifetime. But if you jump firms, if you make a career change, like it's very, very difficult to integrate that. But that's kind of how I think of it, is just through the risk profile lens. Yep.
I think that makes sense. We spent a lot of time talking about this when we did some episodes on intertemporal capital asset pricing model, ICAPM. And we had Sebastian Patermier talking about his paper, Who Are Value and Growth Investors, where he talked about how people shift from having a value tilt or a growth tilt to a value tilt over time as their human capital characteristics change. And we talked to John Cochran. He's got that paper, Portfolio for Long-Term Investors, where he talks about how his kind of like vision for financial advice is that financial advisors could be helping people get their optimal portfolio tilts relative to their human capital. And that would be a really valuable form of financial advice. So for a bit, we were thinking about like, how could we do that? How could we systematically give that kind of advice? And then we talked to Gerard O'Reilly from Dimensional Fund Advisors about it when he was on Rash Reminder, and we were kind of asking for his input and advice on like how could we incorporate that information into designing portfolios. And I thought his answer was pretty insightful. Practically, he was like, I think that's a really smart idea theoretically, but practically, that's kind of like measuring with a micrometer and cutting with an axe. Like we just don't have enough high fidelity information to really make precise allocation recommendations between different types of stocks based on based on what your human capital characteristics are. I asked you to answer first, Mark, because I wanted to find something in the Rationalminder community. Actually, somebody had written notes about Scott Cederberg's paper on life cycle investing. He recently released an updated version of it, and it talks about the correlation between domestic stocks and labor income. So in their model, they have labor income in the model, and they look at different specifications for the correlation between labor income and home country stocks. And they do find that when you have a high correlation between labor income and your home country market, the optimal amount of home country bias does decrease. So, I mean, there's still a pretty high optimal home country bias in their model, but it goes from, I think, around a third in domestic stocks to around 20% at a high correlation between labor income and the stock market. So I don't know. Interesting stuff to think about. I think practically, though, it's kind of hard to, like the Gerard O'Reilly comment, kind of hard to really pinpoint how to use that information in practice. What do you think, Dan?
Yeah, I think this is probably much more of an issue for people who are investing in individual stocks as opposed to having already very broadly diversified portfolios. I mean, some of the things I have seen in the past are people, for example, having a high allocation to stocks in their employer's company, or if, for example, you work in the tech sector and most of your investments are in tech stocks, then you're just kind of doubling down on those idiosyncratic risks. I think if you start from a premise where you already have a very broadly diversified portfolio with minimal exposure to any individual company and only moderate exposure to any individual sector, it's less of a concern.
Yeah. Yeah, I agree with that. Yeah, even like we've looked at some of our clients own some employer stock in like technology companies that make up a pretty large portion of the index. And so we did start wondering at one point, like, should we be doing like a direct indexing model where we can carve these out? And then you look at what the actual percentage of in the overall global portfolio, in many cases, not a 100% stock portfolio. You look at what that stock actually makes up of the overall thing. And it's like, if we have to go and carve something, it's a tiny, tiny amount. So if you have to go carve up the whole portfolio, increase costs, potentially introduce other problems to address that, we decided it was probably not worth it. So I agree. The broad diversification makes a lot of those issues go away.
Mm-hmm. Yeah. I think the other part to that question is interesting as well. Should you tilt away from home country bias specifically? And I think that's largely a currency question. And I guess it's an economic question as well, right? But like if all of your human capital is in Canadian currency, how do you justify the home bias as well? But I think, Ben, your answer on Cederberg's paper looked at that labor income, and I haven't read the paper, but I assume the currency risk was part of it.
Yeah, for sure it was. And it's interesting that you still see a pretty significant home country bias, even when there's a reasonably high correlation.
Okay, next question.
Yeah, next one.
Is that me or you, Ben?
I think it's me.
Okay.
How do you define success in your life? How has this definition changed over time for each of you? Who wants to start?
I got asked that question when I was a guest on the podcast, as of course everyone does. I would answer the question much differently from the way I answered it on the podcast. If I remember correctly, it was something to the effect of, in the past, I think I might have focused more on achievement, professional success, family and relationships and things like that too, although that's a little harder to kind of quantify. But I would say over time, the way it has changed for me is just to try to focus on just being as authentic as possible, and whatever your definition of success and failure in terms of your professional life, your career, just be honest about it and do the best you can in every situation and be as genuine as possible in every relationship you have. And success will typically follow from that.
Yeah, it's good. I was asked when we did the CFA Wealth Management Conference. I think that was last year. I think my answer was something along the lines of you have to enjoy what you're doing. If you're successful, you have to enjoy what you're doing kind of minute to minute most of the time. Not all the time, but you have to be pretty happy with how you spend your time. But you also have to be able to look back on the broader picture of your life and be happy with where you are. And those two things can often conflict because you might really enjoy drinking beers in the hot tub. But if you do that all the time, you might look back and reflect on your life and be like, wow, I have not done a whole lot. How has that changed over time? I don't know. I have a harder time thinking about that one. Definitely having kids changes stuff. But I think that relates back to how you spend your time. I'd be more inclined to stay at the office for 15 hours a day while I was studying for the CFA exams before having kids. I'd be much less willing to do that now. I think
You're
my
down
wife,
to 12 or 13 now.
yeah. I don't think I work that much. I hope not. Depends what you count as work, I guess. I don't know.
Yeah.
I like your answer a lot though, Dan, about how kind of achievement and stuff like that was really important earlier, and that's changed over time. I think that the same is probably true for me too. Spending time with family, having good, not necessarily lots, but good, genuine relationships with a handful of people, I think is really important. But for sure, early on in my career, I was like super focused on got to do the CFA, got to do my MBA, got to do the CFP or whatever. And I'm glad I did all that stuff. But if I had to do it all again now, I don't think I would.
Nice. That's such a big question, right? I mean, because you can fail at a lot of stuff and still be generally a success. So it almost kind of depends on how you weight the things that are important to you as well, right? But I think I don't know, when I make big decisions, I try to fast forward myself to like my deathbed and then look back on things. And this kind of goes to your answers as well, like thinking really big picture about your whole life. So anytime I've got, even joining PWL, I did the same exercise. Like, am I going to look back on my life and say, I should not have done that thing? And I often find that gives me a lot of clarity. And Ben, to your point, once you have kids, or at least once I had kids, how I think about the answers to those questions has changed dramatically. So I agree with a lot of things that both of you have said. I mean, for me, I think it's like, did you leave the world a better place than when you came into it? And even that is super kind of vague, right? But if you can have a positive impact on people and be a net benefit to the human race, I think that alone can be a good definition of success. And then I think separately from that, how your kids and family or anybody close to you kind of views you. Like, what's your legacy over the long run? And you won't know until, was it Alfred Nobel who like created the Nobel Prize because people thought he died and they wrote awful things about him in the newspaper, and then he thought, this is my legacy, and he totally changed.
No, you know what happened there? He invented TNT,
that's what it was.
right?
Yeah,
Right.
yeah.
And he visualized what people would write about him when he died, that he thought people would say, you created this incredibly destructive force.
Yeah.
And so his solution was to create a more positive force, which everybody remembers him now for the Nobel Prizes, and most people forget what he was originally famous for.
So mission accomplished. Good on you, Alfred.
Yeah, it worked.
Yeah. So I don't know. I think family and how my kids perceive me and what benefit I bring to them and just raising them and teaching them to be good humans, and I'll be content with that in the long run. Cool. Okay, next one on me.
I'm going to read the next one because you guys are going to be biased. I'm just kidding. I'm going to be biased too. What personal finance / investment books would you recommend for a retail investor? I think you guys both have great books. Dan, your most recent one is Reboot Your Portfolio, right?
Yep.
Yeah, I read that in full before we had you on our podcast to prepare for that conversation. I thought it was fantastic.
Thank you.
Mark, you've got a book coming out called Wealthier, the Canadian edition. that you're co-authoring with Dan Solon, and I've also read that book. I read the American version before you rewrote it for Canada, and I've also read your Canadian version. Also excellent. Yeah, I mean, so I think those are two great options from people that I know and trust. So that's all I got.
Oh, thank you. I appreciate.
What's the
appreciate
release
nod.
date, Mark, on the on yours?
I've got to call Dan as soon as we finish recording this. So where are we at? So the audiobook has been recorded, which is really cool.
Did you read it?
No, I was going to. Actually, I had
okay.
asked Ben to do it originally, and he, I think, reluctantly agreed to do it. And then as we
Okay.
kind of got closer, I was like, "Hey, man, like, you gonna be able to get this done on time?" He's like, "Yeah, no, for sure." And I was like, "Hey, we got to get this done in 2 weeks." He's like, "Not a chance." And I was like, "Yeah, no, I figured. Like, I wish you just said no in the first place. I know how busy you are," kind of thing.
Yeah, I thought I would do it later, and then later became now, and I
Totally.
didn't have time.
Yeah, it's the story of my life.
As always happens.
Yeah, exactly. But no, Dan has released obviously several audiobooks himself, and so he had a great narrator already lined up, and that narrator had it back to us in a couple of weeks. So really, we're just dotting I's and crossing T's now. Like, the website's ready to go. I think we're just kind of any day now going to hit the go button. So when's this episode being released, Ben? Do you know?
I don't remember the date. I'd have to
It's
check.
December 9th that we're recording this. I'm hoping before the end of the year. It's looking pretty good for some stocking stuffers for Christmas.
Yeah, great.
Yeah. And thanks, Ben. That's very kind of you to say so. But I think
December 26th is the release date.
okay, so it might actually be out by the time people are listening to this. But this is gonna be a cliched answer, I think, because it's become such a super famous book now. But I think The Psychology of Money by Morgan Housel was one of the more impactful books I've read. Even if none of it, I'll say virtually none of it was new information to me. But Morgan's writing style is just so incredible, and the way he reframes thoughts into ways that make me kind of rethink my answers to the same questions is just incredible. So I think I highlighted and dog-eared that book more than any other personal finance book I've ever read.
Yeah, I'd say something along those lines too. In fact, I was going to mention that specific title. I mean, another one would be Thinking Fast and Slow by Daniel Kahneman, which is not an investment book, but I think, once you've gotten to the point where you have an understanding of the fundamentals of investing, and you're going to get to that pretty quickly with any number of introductory investment books. I'll back up and say, like, for me, in my formative, period, it was like John Bogle, and Larry Swedroe, like,
Oh, yeah.
that kind of stuff. And I, read all the classics of indexing, Random Walk Down Wall Street and Winning the Loser's Game and all those. Those are kind of out of date now in the sense that they don't offer a lot of practical investment advice, but they do ground you in the theory of just how difficult it is to beat the market and why it's mostly a huge waste of time. But once you get to that, the stuff that you need to keep reading, even after you think you already know it, is the behavioral and, the behavioral investing and behavioral finance stuff, because we're all so prone to that. Kahneman talks about it in his book. It's even when you're aware of the biases, you will still fall prey to them.
Yeah.
So you have to keep reminding yourself how difficult it is to be an investor from a behavioral point of view. Most of the rest ends up being details once you have a fundamental grasp of the concepts.
Yeah,
Yeah.
that's a great answer. I'll throw one more in the ring, and I've talked about this book before. Hopefully people can see that. It's probably backwards on the video, but that's Christine Van Cowenberg's Wealth Planning Strategies for Canadians. She releases an updated version every year. I have it on like subscribe and save, basically, through Thomson Reuters. So every March or so, I get a fresh copy. It's a reference guide to all things financial planning. So if you're a DIY investor who really wants to get into the financial planning side of things, like, I don't think there's much, if anything, in that book about investing. But there's lots on like family dynamics, tax implications, estate planning, insurance, disability planning, everything you can think of. So I think it's like 1,000 pages, but it's also really, really well organized, because the first half is organized by sort of relationship status. So it's like, if you're married, here's a section for you. If you're divorced or separated or widowed, so you can kind of just go to the section that applies to you, and then you can just read through that entire section, and it's really, really enlightening. And as a reference book, I go back to that book almost daily for financial planning questions.
It's very well written for a big door stopper of a reference book. Like, you're not going to sit down and read it sequentially, but whenever you zero in on the section you need. It's extremely clearly written. Yeah, it's a pretty invaluable resource, I think, for anyone in financial planning.
Yeah, no, for sure. And it's the end of each section contains a appendix that goes through the differences on a per province basis. So it can apply to you regardless of where you live, which is pretty rare because a lot of things like family law, for example, really are provincial domains. And so if you're reading something on a blog and you don't realize that it's actually written for an audience in a different province than you might actually take away the wrong understanding of the answer.
Yep. I've got the 2024 edition, not 2025. You're going to think I'm crazy based on what you just said, Dan, but I read it cover to cover.
Yeah.
That doesn't surprise me, actually. Yeah.
So I did really too, because it was
good book.
It's one of the textbooks for the CLU designation. And so I found that I originally read it cover to cover, and that's what kind of led me to realize how powerful of a book it was for a practitioner, and I think for DIY investors as well. Okay, next one.
Yep.
Is that me? I think it's me, right? Okay. I expect Ben's probably going to answer this one, but could you cover the approach on how to assess a value premium within an ETF, please? The only small cap value funds available in the UK are the US and European Spider MSCI, as an example. Love the content. And that's from Nick.
So you can assess the exposure to the value premium with an ETF by running a factor regression. That'll tell you its historical exposure. And then you can also look at its characteristics. So you can look at a value metric like price to book, and you can see how the fund you're looking at compares to the index or to some other benchmark. That's really it. You've got factor regressions for how it has had, how its exposures have been historically, and then you've got characteristics for how its current exposures look. And that's pretty much it. There's a lot more than just looking at those things, though, that goes into choosing a fund and an investment. So, caution is warranted. There's a reason that there are threads in the Rational Minder community with many thousands of posts discussing, which value fund you should pick if you're in the UK. So, and there are topics on that topic that are, extremely long. There's a reason for that. It's not as simple as a single metric. So that's kind of it.
And you should do a YouTube video one of these days on how to do a factor regression. I tried to figure it out on my own with absolutely zero technical background or training in that, and couldn't figure it out at all.
I think Justin Bender used to have blog posts on that. I don't know if they're still up.
Oh yeah?
Yeah, I think I worked on those with him. Well, basically I just translated, but yeah, we'll have to dig through and find them. I'm sure there are better way or more efficient ways to do it, maybe better access to data than there used to be. But that was a fun exercise to do because, of course, I had no clue and still couldn't do it with a gun to my head. But at least I understand the basic idea of what they're supposed to achieve and the raw materials. So.
There's tools now too. Like back then when Justin wrote those posts, I don't think Portfolio Visualizer existed. Now it does exist. So like, how much do you really need to be able to do it in Excel? I don't know. Could be a good video though. I'm sure people would watch it.
Yeah.
All right. So next up, this question is from SA. What is the most profound personal experience you've had that changed the way you guide your clients? Wow. Big one. Who wants to take that first?
So, on just like happiness and life being precious and all that kind of stuff. My mom had breast cancer when I was younger, and that was a profound experience that really kind of changed my perspective on life. She survived, but it wasn't obvious that she would. And then some recency bias. I was playing basketball a week ago when we're recording this, a few weeks ago when it comes out. I played with the same group of people on Thursday nights all the time. And we were in between games, not even playing. And one of the guys that I've known for years now, he was walking toward the end of the court and he just collapsed and his heart stopped. And we were able to revive him. Two of the guys knew CPR and knew how to use a defibrillator. And he went to the hospital. He was okay in the end, but it was freaking terrifying. And stuff like that, it just really highlights that like this life does not go forever. It kind of comes back to my comment on success. Like you have to enjoy what you're doing all the time because you don't know how long it's going to last.
Well,
oh, how does it affect clients? I mean, I think that's why did we do all of this content that we did on happiness and on living a good life and how investing and financial decisions relate back to that. It's for that reason. Like we don't exist as advisors to make people the most money possible for the sake of having a lot of money. We tie it back to living a good life. And there's evidence around that to an extent that I think we try to use to help people really get the most out of their lives through their money. I mean, that money is such a powerful tool in determining how people are able to live their lives. And I think that's the approach that we try to take to giving advice.
Mark, do you want to take that?
Yeah. It's a great answer, Ben. I've talked about what happened with my own father on the podcast before, and I've written about it, and I think that was obviously impactful. It's these kind of unforeseen events that you kind of just throw up your hands and go like, what am I saving money? Like YOLO, like you really just, you got to go out and do the things that bring you joy, and you can't really wait for anybody else. And so you kind of learn that just through things happening to you in life. But in terms of how to guide clients, it's difficult because you have to find some kind of balance. You can't plan assuming that's going to happen, right? Like we have to,
right,
for clients, generally plan for worst case, not worst case, but call it worst case financial scenarios, which is like a really, really long and healthy life where you get to spend money and you're active and everything else, right? We're looking for financial stability. And so it's hard to find that balance, I think. But outside of that, I mean, like even Dan, like your blog was profoundly impactful on how I guide clients. And so this is maybe a little bit more quantitative, and I've talked about this before as well. When I found your blog was my introduction to index investing. And that was like a full on epiphany for me at the time that I really started getting into it. And it completely changed how I work with clients, not just on the investment portfolio, because that's obvious, but by switching clients into index funds and understanding things like markets work and are relatively efficient most of the time. And you don't need to spend all this time on, analysis and stock picking and reading research reports and listening to fund managers. It just opens up all of your time to do other work for clients. And that wasn't as obvious to me until it started happening. And I was realizing like, oh, now I can actually spend all this time being a financial planner. And it was only through that it really occurred to me that it's these other areas of financial planning that are equally, if not more important than, portfolio design. And so that totally changed the trajectory of not only my own career, but how I actually think about delivering advice and think about what good advice is. So.
Well, thanks. I'm glad to have had a positive impact. And it's funny because if I take this question, to the second part of it, which is how has it changed the way you guide your clients? Remember, I came at this industry the opposite way that you did, Mark, right? Like I was, I think, still kind of writing about it and not in the industry while you were already working with clients and I was not. So I was later in the game. And when I first started doing this, my understanding or my impression was, I'd written so much about investing. I wasn't really writing about financial planning. It wasn't really an area of my expertise other than at a very basic level. And I assumed that most clients who wanted to work with me were primarily interested in investing. And so, all of our initial discussions when they were prospective clients and early on was how we're going to build a portfolio and what the strategy was. And very much investment focused. And gradually I started to realize most clients, I would say, aren't really too interested in those small details. And I can remember the first time I worked with a client, it was pretty early on in my career. First time I had a client pass away. And when you work with their surviving spouse, you quickly realize your value is not that how to build a portfolio with maximum diversification on the efficient frontier. It's that you're going to be there, right? And offer, the comfort and support that people need at a very acute, event like that, but also on a much larger scale, right? It's just clients want to know they can trust you and that you will be a good steward of their funds and that you will give them good advice that's in their best interest. And the rest is details, right? Like that's 95% kind of what we do, I feel, in the value that we add. And it took me a few years though to truly come around to that and start to focus a lot less on investing and really try to improve my skills, A, as a planner, and B, just as someone who can have some empathy for clients and, get to know their lives and deliver, our value in that way rather than just sort of portfolio construction.
I've got one more actually to add. I was thinking a different kind of profound, I guess, but I wrote an article, or I was interviewed for an article in the Globe and Mail in my first year in financial services when I was selling actively managed mutual funds. And I mentioned one of the funds that I liked, and I got absolutely roasted in the comments of the Globe and Mail. Absolutely roasted. And it was a wake-up call. It was like that forced me to go and look at what I was doing and what I was being taught by the place that I was working at and the fund companies whose products I was selling. So that was eye-opening, and that's what led me to discover indexing and Dan, your blog, and PWL. So yeah, different kind of profound, but that definitely had an impact on me. Being roasted on the internet is a great way to learn.
Well, it depends on your personality. I know a lot of people that get roasted on the internet and seem to be allergic to learning anything new. So,
and you were roasted in the early days. You were like an OG victim of internet abuse. I mean, that was pre-social media. It sounds like it was just on the web, right?
Yeah, on the web comment section of the Globe Mail, and unfortunately, that they changed their comments engine, so you can no longer go and find those comments. In hindsight, I wish I'd screen capped them and framed them.
Yeah.
But yeah, definitely changed the whole trajectory of my career in this industry. Who's next?
I don't remember.
All right,
we're on number 9.
Yeah, number 9. What are your thoughts on the concept of return stacking, where products utilize futures leverage to make space for diversifying alternatives, trend following, for example, trend following and carry? Sure. If you're into that kind of thing, I mean, I don't have a super strong opinion on it. We don't use it for clients. Not that interested in starting to use it for clients. People come to us because we manage portfolios in a way that's very, very simple and evidence-based. People that advocate for return stacking might say that it's also evidence-based, but there are levels of evidence that's going to make people mad. I'm sorry. But they're also just the simplicity of the way that we invest with index funds or dimensional funds. It's really easy to communicate to clients. People get it. People want it. And if the market does poorly, the portfolios do poorly, that's it. Having to explain something more complex is just not something that I think we need to do. And you said, Dan, in one of your posts, you were talking about factor investing actually, but you said that, nobody failed to achieve their goals because they didn't have a small cap value tilt or whatever. But I think it's a really insightful statement. And I think about it a lot that we could maybe we could find some better way to, maybe nothing's going to be guaranteed, but maybe we add in return stacking and we start using futures to get access to other sources of expected return of portfolios. How much is that going to change the expected outcome for our clients? And how much certainty do we have around how it's going to change the expected outcome? No, I don't have enough confidence.
What is the risk that any change might be negative?
It might be negative or might be perceived as negative. Mm-hmm. And what if the clients can't stick with it because they don't understand the strategy, all that kind of stuff. So I don't know. I know this is kind of the hot thing right now, return stacking. It's not actually a new thing. It's portable alpha. It's been around for a long time conceptually. It's being marketed a lot right now, which is fine. And I'm sure the people who make these products are very smart. I follow them online. I like them. But it's just not something that fits with the way that we think about markets or our business model or what our clients want. So those are my thoughts.
I'm good to leave that one there. I don't have a lot of thoughts. The people who are largely involved in that story right now. Is it, I want to say Resolve and Corey Hofstein and Rodrigo? Am I thinking about
Yeah.
the right thing? Yeah. Those guys are awesome. Like
They're
huge
awesome
fan.
and they're brilliant.
Yeah.
It's
Like
not a
love
knock
their
against
stuff.
them. It's just,
Yeah. No, I just want to preface it with that. I have a ton of respect for them and follow it and I've learned a lot from them. But yeah, I agree, right? I mean, it's more complex. There's additional, risks there. And to your point, like, are our clients going to fail to achieve to meet the outcomes that they want because they didn't add a bit of leverage to their funds? I don't think so, right?
all right. The plan was to not skip any questions, but this next one's like a 5-part question. So I think we can skip that one, unfortunately.
Sure.
It's just too much. One of the things we try and do when we interview guests is we never have 2-part questions. If you listen to our episodes, very rarely, if ever, do we have 2-part questions because it's really hard to answer them.
Mm-hmm.
So that question was like 5 parts, and it's not easy to answer.
I'll go to the next one then. Oh, sorry.
Oh yeah, no, I just read the last one. It's not.
Yeah, it doesn't matter. Yeah, okay. All right. Can you speak to the recent changes that Dimensional has made to their vector portfolios? How do they now compare to the approach of a firm like Avantis?
So Dimensional hasn't changed their methodology, but they have changed the emphasis that they're giving to the different factors. So the vector portfolios used to have more of a small cap value tilt. They've changed the methodology to have a more equal emphasis on size, value, and profitability. And that's based on their research that shows that the premiums are not statistically different from each other. And so having an equal emphasis on them gives the best expected outcome, basically. Like there's no good empirical reason to tilt more towards small cap and value than toward profitability. So they made a bit of a change to the methodology. How does that compare to a firm like Avantis? I think Avantis did have more profitability exposure, so maybe it brings them closer, but overall they still have differences in their methodologies. So the underlying methodologies have not changed. It's just the way that Dimensional's emphasizing different return premiums has changed a little bit.
All right. Should we jump to the next one?
Yep.
This is a good one, actually. I'll read it, but Ben, you'll be the guy to answer it. Much of the public discourse involving factor investing seems to concern equities exclusively. Yet, are there equivalents for bonds and fixed income? For example, risk factors such as maturity, term length, credit rating, etc. How should individual investors consider such factors for bonds, bills, and credit holdings?
Yeah, I mean, it's the expected returns overall are lower in fixed income, so I think they get a little bit less attention. But we did an episode with the head of fixed income from Dimensional, Dave Pleka. We also did our own episode on factor investing and fixed income. I don't remember which episode numbers those were, but you can go and look them up. So I mean, there's something there. Like there's good evidence on a term premium. There's good evidence on a credit premium, although a little dicier maybe on credit, depending on how you look at it. There are funds now, like from Avantis, and I think Dimensional now has ETFs too that are available that do this. They have broadly diversified fixed income portfolios that do put emphasis on return premiums within the fixed income space. Do you need that? Again, I mean, I love Dan's point about is anyone going to fail to achieve their goals because they didn't have a tilt toward credit in their portfolio? Probably not. I think simplicity is super important. But I mean, listen, it depends how much each individual wants to optimize their portfolio, how confident they are in the return premiums. I don't know how much time they dedicate to it, but we use, like in our portfolios where we're using Dimensional funds, they do tilt toward different fixed income factors at different times. That's one of the, I guess, unique things with fixed income is that the tilts change over time. The cash flow side of fixed income is much more certain than with equities, which it makes you a little bit more confident that differences in expected returns are all about, or differences in prices are all about discount rates. And so Dimensional does vary their exposure to longer and shorter maturity bonds, and they vary their exposure to different credit rating bonds based on prices. So we use funds to do that. Do you need that? I mean, I don't know. So how should individual investors consider such factors? I mean, If you want to pursue them, there are products that do it. Do you need them to meet your goals? Probably not. PWL does use funds that do consider factors in fixed income. Anything from you guys?
Not really.
No, I don't think so.
All right. Oh, I love this question. How do you explain the discrepancy between past results are no guarantee for future predictions? I don't know if that's what it means to say, but I think people know what I'm talking about. Versus the stock market had returned 7% on average per year, and we'll use that to predict your money's growth for the coming 20 years. Feel free to rephrase. Yeah. So, I mean, I think the question is like, how do we square the statement of past returns are not a guarantee of future results, which is kind of a standard disclosure in financial services? How do you square that with thinking that we're going to get positive returns from the stock market going forward? I mean, the first thing that I would say is the stock market had returned 7% per year. We'll use that to predict your money's growth for the coming 20 years. That's not how we do it at all. So that's the first comment I would make. We at PWL look at the global average across all stock markets and make some adjustments for valuations. We net out the portion of return that comes from historical valuation changes. We also apply a portion of our estimate that comes from the current valuation of stocks. So when stock valuations are really high, our expected return estimate is going to be a little bit lower. So we do make some adjustments, I think, to try and be conservative. And we also look at all stocks across stock markets across the world, including markets that have failed and closed, to try and not have an upward biased estimate. Yeah, I mean, that's one piece of it. And then that statement is like a regulatory disclosure. So I don't know if we need to square anything we say with it, but I think the general idea that how can we look at past returns of anything and think that it has information about the future, a big part of it is why did that happen? So there's theory behind that. Stocks should be riskier than bonds, and that makes sense logically, theoretically, and empirically all around the world. So directionally, the idea that a riskier asset should have higher expected return, I think we have pretty good reason to believe that. As a point estimate, though, like, can you look at historical returns and say that's what you're going to get in the future? No, I don't think that's the case at all. What do you guys think?
Yeah, I think, like, in my view, it's not a prediction about what your money is going to do over the next X number of years. It's that we need to make reasonable financial planning assumptions, right? And I think, Ben, the description of how you arrive at PWL's financial planning assumptions is just that's the best way that we are aware of to come up with what we believe to be a reasonable assumption. And that's our starting point for financial planning. But then we also do all sorts of stress testing and scenario testing. And so right. I don't think at any point I've ever told a client I predict this is going to happen. It's more, these are the assumptions we're using in this plan. We can look at different assumptions. We can look at what if your portfolio is more conservative or more aggressive, or inflation's higher, or run Monte Carlo analysis. But it is largely true that past performance doesn't predict future returns. And that type of disclosure and compliance statement, I think, also applies more specifically to like very specific products more so than it does to general financial planning assumptions, right? Like if you see a fund fact sheet or something like that about a whatever it is, technology sector ETF, and it's done 18% annualized for 10 years, there's a reason that disclosure is there, is because you can't just assume that that's going to happen in the future. And a lot of people would be sued without that disclosure. So I think that's more product specific, whereas what we're doing, I think, is more financial planning specific. Yeah,
that's a really good point.
Yeah, I think that you hit exactly it, Mark, is that, if you're, as a financial planner, you have to use assumptions, right? I mean, you can't, what are you doing if you're not going to apply some sort of assumptions? And then so the question becomes, your assumptions just have to be as reasonable as possible, and you have to be able to back them up, right? If you're going to pull a number out of the air and say stocks are going to return 10% a year, you need to be able to defend that, and it's hard. And I will say, like, PWL now does a really good job, I think, at its expected returns assumptions and the methodology. And I know, Ben, you're intimately involved in doing this, and maybe you want to share a little bit about that experience compared to the way other organizations do it, which may be better or worse. I don't know. But I think I've been very impressed with the way PWL has come up with a methodology, and we update it twice a year. We use those updates in our financial plans, and I feel very confident, using them for clients for sure, which I've definitely seen other return assumptions that seem a little bit, let's just call them optimistic.
Yep. I think it's getting better. Like we have FP Canada has been issuing expected return assumptions for a while now. I'm on that committee now. This year is my first year there. We did make some changes to move a little bit more toward what PWL does, just including some input from market valuations, which I think are really, really important. But yeah, building the PWL methodology was a great experience. That's something that I spent a ton of hours with, working with Ray Crisero at PWL, just figuring out we needed something simple that we could explain to clients, but that gave us good information about expected returns. It took current market conditions into account. And so I like our methodology a lot. I think it's easy to explain, gives reasonable estimates, and responds to changes in the market, which I think are all important characteristics for expected return assumptions. But there are lots of organizations out there now that have, I think, reasonable enough expected returns that are published. Like BlackRock has them, Vanguard has them. Conquest Planning, the financial planning software that we use, gives us access to a set of assumptions as well, if we didn't want to use our own. And they're all within the same kind of range. Mm-hmm. But yeah, it's much different from, using 10% a year, which unfortunately I think some people are still doing.
Oh, yeah. Okay. Next one. Do you know some tax exempt ETFs? If yes, what are the pros and cons? It's difficult to find ETF with a built-in capital loss, only return of capital or reinvested distributions, low turnover, and less actively managed. So I think what this question, and this is from Gerald. It's a French name. I don't know how to say that with a French accent. Gerald. I don't know. I think what he's probably talking about is corporate class funds, which I don't know if you've talked about that much on the podcast, Ben, or if anybody has. But
yeah, it's probably one version of. I don't know what you might have been talking about. There's a few ETFs that have launched recently that are like anti-dividend ETFs that aren't holding any dividend stocks to try and be more tax efficient. I don't know about tax exempt ETFs though.
It could be the total return ETFs by Horizons or now Global X, or just corporate class funds in general that try to wipe out any taxable distributions.
Yeah, it could be that.
Yeah. I don't have a ton of experience with them, but I think he's mentioning it's difficult to find an ETF with a built-in capital loss. So I think what he's talking about is usually a mutual fund is a trust, and it can be organized as a corporation where the fund or all of the funds that are within that corporation can have gains and losses or income and losses offset against each other. So you might have fund A that's lost a lot of money, and then fund B that's gained a lot of money, and those losses and those gains can offset such that the taxable investor isn't required to pay tax on the income or gains of the fund. So those are called corporate class funds. I think, like on the surface, those are really interesting in some cases, but I think there's a trade-off because there's not really a lot of options in that space, and most corporate class funds are actively managed high fee funds. So what you might gain in tax efficiency, you might lose elsewhere. There is the Global X funds or Horizons funds, which they've undergone some changes, but I think primarily, and Ben, you know more about these than I do, but I think primarily now the tax efficiency comes from the corporate class structure, not from their old structure. So I don't know if you want to talk about those funds, but.
Yeah, and I think you have to be careful with corporate class in general because they can, and Mark, I think you and I looked at a case of this recently where a corporate class fund can look more tax efficient because of the distributions that it pays out to you as the fund investor. But the fund corporation can actually end up paying quite a bit of tax at the fund level. And when you combine the two layers of tax together, corporate class can actually look less tax efficient in some cases than just owning the ETF on its own. With the Horizons Total Return Fund specifically, they are still using a total return structure. So their returns are coming from fully taxable derivative income. inside the corporate class. And they have a big loss carry forward, which they can use to offset net taxable income in the fund. They banked some serious losses during COVID by realizing swap contracts. But as that loss pool kind of gets smaller and smaller over time, the risk with those funds is that if there's net income in the fund, so if the fund corporation has to pay tax on net income, which just means like the index, the swap contracts are positive because the indexes have gone up, and the fund corporation has to realize the income on one of the swap contracts. That net income is taxed inside the fund and then allocated pro rata to the fund that was kind of responsible for it. And because of the way a mutual fund corporation is taxed, when you net out all of the numbers, it's possible for you to end up worse off for having invested in that corporate class fund than having just held the underlying assets in a mutual fund trust. For different types of income, the threshold for that is different. Mark Soth did a series of blog posts on this that I thought were really good. Him and I kind of worked on thinking through those products together. But our position on them right now is that we're not super comfortable with the risk of that net income happening inside the fund. And we're also just a little worried about the, I don't know, longevity of that structure. And I know, Dan, you and Justin talked about this years ago when they had the previous structure before the tax changes forced them to switch to a corporate class. And you guys kind of had the same position, which really kind of influenced how we thought about it back then. And I think now with the current structure, it's a different set of risks, but we're still not comfortable with it.
Yeah, anytime you layer on some, tax efficient structure, given the climate in Canada regarding eliminating perceived tax shelters, which are typically assumed to benefit only the wealthy. It just seems like these are in the crosshairs of government. We've just seen it over and over the last 15 to 20 years. Who knows, right? Whether such a structure will survive, but it does seem at least possible that this structure could eventually be eliminated by legislation, and then you're in a situation where you might have forced liquidation of the fund, and it's just, again, one less thing to worry about. So far, it's worked out extremely well. I will have to say, anybody who's owned the formerly Horizons, now Global X funds for the last 10 or 15 years has deferred a lot of tax, especially on the U.S. side. Mm-hmm. But, look, U.S. equities right now, what's the yield is less than 2%. So you're not really paying all that much tax on distributions from a traditional U.S. index fund right now. Most of the gains has been capital gains, even in a traditional ETF structure. So I'm not sure how beneficial it actually is going to be going forward.
And they have funds for international stocks and bonds too, which again, like the case gets stronger, but the risk still doesn't go away. Because
for sure,
the problem is the total return. In the event of net income, there's potential for the total return to be taxed as income inside the fund, as opposed to the mix of capital gains and foreign dividends or interest that you would have had as an individual. And so there is a possible outcome where that ends up being less tax efficient. And there's also a possible outcome where if that becomes an issue, that these funds, like you mentioned, Dan, could close down, which can cause other problems. Well, that probably wouldn't happen. They'd probably just switch to being a regular fund at that point. But in any case, it's, again, is it going to be the difference between our clients meeting their goals or not? Probably not. Does it introduce additional complexity and risks that we'd have to worry about and the client would have to worry about? Yes. Does it make sense for some people? Sure. I mean, I know Mark Soth is a fan of them still, despite understanding the risks. But him and I have talked about this, and we kind of agree that it's very different for an individual to say, yeah, I'm comfortable with these risks, than for a firm like PWL to tell our clients, yes, we are comfortable with these risks. Those are two completely different animals. Yeah. Next one we can skip because it's very specific to a U.S. account type.
Well, can I ask it and I'll spend 10 seconds on it?
Oh, sure. If you have.
Yeah, I think there's an interesting answer that's going to be general enough that could be useful to listeners. But so the question is, how would you invest the TSP in parentheses, it's thrift savings plan. It's the federal government's type of 401k. And this is from Keith from Connecticut. So a 401k is kind of like almost like a group RSP. I think it's like an employer sponsored tax deferral plan in the US. And I've never heard of the thrift savings plan, but it sounds like it's relatively equivalent. And without getting into the nuances or technicalities of how these accounts work, I just thought it'd be interesting to, or at least maybe useful to think from a framework of how we allocate assets or investments to our portfolios. And I think about it as, I think about my portfolio first and then what buckets to use later, right? And not the opposite. So we've talked about like asset location, Ben, and I know you've done a lot of work on this, but for me, if a 401k type plan or a thrift savings plan is a retirement asset, then it follows the same guidelines as the rest of my retirement assets in terms of how I invest them, right? So again, I don't know anything about the thrift savings plan, so maybe this is a terrible answer, but I would honestly, if it's in that retirement bucket, I'm investing it the same way as all my other retirement funds.
I'm too nervous to know nothing about the account type and say something that doesn't mean anything. So you're.
Oh yeah, you could be like, no, actually, it doesn't work this way, and your answer is dumb, and maybe that's true. But I just think because I get this question in a different way a lot of the times, like how would you invest this versus like this type of account versus that type of account? Look, it's all fungible. Like it's all one pot of money for me in retirement. The tax treatments are going to be different, but I'm not going to make different portfolio decisions based on that. I'm allocating everything that's in the retirement bucket gets invested the same way. And then I choose which buckets, whether it's TFSA, RSP, or what have you, to put that in. But the portfolio for me doesn't change based on the type of account. And maybe there's some nuance on US plans that make that answer terrible, but that's how I think about it.
Yep. Anything to add, Dan?
No, I think that's the right approach. I mean, I remember back when TFSAs were first launched and people would ask questions like that. What should I invest in my TFSA? And it's like, well, what are you investing in the rest of your portfolio? And it took us a while to realize, asset location considerations do need to be considered, but these are not fundamental questions. Like you're not gonna use different strategies or hold fundamentally different funds necessarily depending on the account type. It's important to think of the portfolio as a whole when making any decision like that.
Yep. All right. In terms of portfolio construction, is there ever a case for buying anything other than VEQT or the S&P 500? If a higher risk appetite existed, what other ETFs or assets would be recommended? So, I mean, I wouldn't just buy the S&P 500. I think that's the first thing that I would say here is that it's, even though it has revenues from all over the world, which is the common argument for just investing in the S&P 500, I think it's still got a lot of concentration. In the U.S. market, it's still companies that are subject to U.S. tax rates and financing costs, which are not diversified, even if the revenue streams are. And to the specifics of the U.S. market, there's a question coming up, I think, on valuations in the U.S., which, they're pretty high. I'm not predicting that U.S. market's going to crash, but valuations in the U.S. market are very high relative to history. So anyway, I wouldn't invest solely in the S&P 500. VEQT, on the other hand, is a globally diversified equity portfolio. It still has a decent chunk in the U.S., but it's also got a big chunk in Canada and in international developed and emerging markets. So that's fine, but it's also a 100% equity portfolio, which is not going to be right for everybody. I think you have to be aware of your ability to take risk, also your willingness to take risk, your comfort with volatility, all that kind of stuff. If a higher risk appetite existed, that's kind of our view on this, is that tilting toward riskier stocks can make sense if you really want to take more risk. You can also use leverage with whatever your optimal portfolio you decide is. If you really want to take more risk, you can borrow a little bit of money to invest more in that thing. That, of course, comes with its own risks and complexities that people have to make sure they understand before doing it. But
yeah, I think that's a great answer. I think, yeah, I agree that I wouldn't ever be 100% equity in one country. I think recency bias is driving a lot of this conversation about the S&P 500. And it's been a long time that the U.S. has been doing really, really well, but there's other periods in history where you'd be crazy to invest only in U.S. stocks just based on recent 5 to 7 year performance. So I'm not really convinced that the U.S. is always and forever going to be the source of the highest returns around the world. Something like VEQT is great. And I think, Ben, one thing that's should be really clear is when you're talking about more risk, you're talking about more compensated risk, right? Like you can take more risk by holding 2 stocks instead of 10,000, but you shouldn't expect higher returns from that. You should just expect a lot more volatility and dispersion. So how do you take compensated risk but increase the risk of the overall portfolio? And I think probably leverage is the best answer to that. Not a recommendation, because compliance is going to listen to this podcast. I am not recommending leverage. I'm just saying that's how you would kind of juice the returns if it worked out in the long run.
Well, I will say too, just kind of reading between the lines of this question, when somebody asks, or somebody implies that they have a higher risk appetite than 100% equity portfolio, the alarm bells go off for me, right? Because I want to know, what exactly have you experienced in your investing life? Because if you lived through 2008 with a leveraged 100% equity portfolio, I'm sorry, but very, very few people can do that. It's extremely easy to overestimate your risk tolerance, and it's very easy to do it following a couple of years like we've just had in the markets. So, I mean, have you ever met anybody who you felt in order to meet their financial goals need to leverage 100% equity portfolio? I mean, they don't exist, I don't think. If you need to take that much risk, then you got other problems, right? And I'm not saying that to be derogatory. I just mean if you can't meet your financial goals with the expected return on a 100% equity portfolio, then the problem is more likely that you need to save more or expect to spend less or invest for a longer period of time. Taking more risk is not the answer there.
Yeah, that's a great answer.
Yeah, I agree with that. I will mention it's worth giving a nod to Scott Cederberg's research here, just on the question of what is risk. Like in this case, at least the way I read the question, it's kind of asking about risk framed as volatility. But Scott Cederberg's research, and then also David Blanchett has a recent paper out looking at just how risk changes over very long periods of time. At very long horizons, like 30-year horizon, volatility becomes a little bit less important, and the higher expected return of stocks actually, in some samples, makes them a little bit less risky than bonds, which tend to be more affected by inflation risk. Stocks tend to have negative autocorrelation, which means that after a recently bad period of returns, you tend to have a good period, and after a recently good period, you tend to have a bad period. That negative autocorrelation makes stocks a little bit less risky at long horizons. Bonds tend to have positive autocorrelation, where you have negative bond returns in real terms, usually due to high inflation. That tends to be persistent, meaning you tend to have a few years of really negative bond returns, which makes bonds a little bit more risky at very long horizons. So while bonds may be less volatile in the short term, they can actually be riskier at long horizons. But I mean, to your point, Dan, you still have to be able to live with your portfolio. And I don't know if people always appreciate what it feels like to live through a proper long-term downturn. Like a lot of people live through COVID and we're like, hey, that wasn't so bad.
It lasted 3 months. Yeah. And then, by the end of the year was, highly positive. That's not what we're talking about. And it's a great point, though, about risk equals volatility, right? Because there are many types of risk. But I think volatility is the risk that makes people behave badly.
Yeah. Mm-hmm.
And that's the reason why you temper an all equity portfolio with fixed income. It's not because you want to reduce your long-term risk or you want to enhance your returns, because you won't be doing either of those things. But you will be dampening your short-term volatility, which is what gets most investors into trouble.
I think the other thing you pointed this out, Dan, is, it gets you thinking, like, what have they not been through? Like, what have they not seen in their portfolio? Mm-hmm. And I think often this type of question comes from somebody who usually is kind of younger, just getting started, and is trying to figure out how they can accumulate as much wealth as possible. And so somebody like that who does go through that type of event in the near term is likely going to do so with a smaller portfolio. And so even if they have gone through some kind of market volatility, the dollars may not have been that impactful. And they think to themselves, oh, that's easy. I lost 50% of my portfolio is only $3,000 at this point. once you go through that with a 7-figure and 8-figure portfolio, if you get there, like the conversations with my clients are in dollar terms, right? It's like
Yep.
we're down 40%. That's $4 million, right? So it's not, they don't think in percents as much as they do in nominal dollar terms, I find. And so I think there's very few people who are saying, how can I increase the risk on my portfolio if you've gone through an event like that with a reasonable sum of money?
For sure. Yeah. So
Okay, who's up next?
I'll take the next one. This question is from Al, but I have to admit, when I first saw it, I thought it said AI, and I thought it was like a, chat GPT generated question, but it sounds like it's from a real human. So Al says he's 34, planning for the long term and just starting his investing journey this year. And his question is on a lot of people's minds, I think. He says, given the overvaluation in the S&P 500 and the significant returns over the past few years, does it still make sense to stick with the asset allocation approach of allocating around 45% to US markets, or would it be prudent to reduce this exposure? Probably the most popular question most of us are getting these days from clients and otherwise.
Yeah. And Ben, I bet you're going to have the longest and best answer to this. So I'll just go quick here. I think, one, we don't know that the US market is overvalued, right? I think we can probably only really say that it's highly valued historically speaking, but overvalued, I think you can only really identify in hindsight. So I think that's an important distinction, right? We know it's expensive historically, but we don't know that it's overvalued, because overvalued assumes a correction is coming. We don't know that that's going to be the case. And the rest of the question is kind of leading that idea, right? Thinking like, should we reduce risk because we're expecting a correction? We just don't know, right? I mean, the US market has been expensive for many, many years and still continues to go up. So by reducing your US equity, there's potentially an opportunity cost if markets do kind of keep going up. The other thing I think that is perhaps more important is that this individual is 34, planning for the long term and just starting their investment journey this year. And so if they're really just getting started, going back to what I said in the previous answer, like even if you're right and the US market crashes 50% tomorrow, the actual dollar term exposure that you have to that crash is not likely to be meaningful to you over the long run in terms of your financial plan. So I wouldn't, if I'm just getting started in my journey, I wouldn't start trying to think about tactical asset allocation in my portfolio. I mean, we don't really use that even ourselves. And I don't think investors like that should get hung up on questions like this. I think like just get started, just go with an asset allocation ETF for some fund of your choosing and just start putting money into it. And then, just see how things go. But it's not likely, even if the market crashes, it's not likely to be meaningful to your long-term goals if you're just getting started.
Yeah. I think if it were obvious that the US market were overvalued, its value would decrease. And we would see a correction back to whatever it should be. So I agree with you, Mark. You can't really say that it's overvalued. It's relative to its own history. It's highly valued. I was looking at the numbers for Japan this morning, just because this topic is coming up a lot right now. And I did actually do a Twitter post that maybe I shouldn't have done because it probably exacerbated this type of thinking from people. But I showed that there's only a few months in history where U.S. equity markets have been as highly valued in terms of the Shiller CAPE ratio, the cyclically adjusted price earnings ratio. Only been a handful of months in history where they were at their current level of valuation, at least on the day that I did the tweet, or higher. And all of those months were concentrated around the 1998 to 2000 period where U.S. stocks went crazy during the dot-com, what ended up being bubble. We didn't necessarily know that at the time. And on average, in all of those handful of months where valuations have been as high as they are now, the 10-year forward return, the 10-year return following that starting month, has been on average negative, like it's negative 1.29% annualized for all those periods. So, I mean, that's kind of scary, right? But to your point, Mark, we don't know if current valuations are high relative to the future. We only know that they're high relative to the past. And my little example there is a tiny sample, like it doesn't mean that much. I was poking around the data for Japan, and I just want to share a couple interesting points there. Japan, of course, famously had insanely high valuations, at least in hindsight, in the 80s, leading up to 1989 in December is when they had a crash. I don't know if people are familiar with the story, but if you invested in Japanese stocks in December 1989 and held them until now, I think your annualized return in nominal terms was about 1%. I think it might have been 1.19% annualized. But in any case, very, very low. And adjust for inflation, adjust for treasury bill returns, it was a negative return. So not very good over such a long period of time. That's December 1989 until November 2024. So that's a very long period to not get any returns from stocks. Now, on the way up, though, and this is the part that's interesting to think about in the context of U.S. valuations. If you look in like June 1985, Shiller Cape for Japanese stocks was about 38, which is roughly where it is now. If you look at the 10-year returns starting from that point, Japanese stocks actually beat world, excluding Japan, stocks for the following 10 years by about 90 basis points annualized. So, valuations can be really high and you can still have positive returns. And in that case, you can still have returns that beat other geographic regions.
And that assumes you invested your entire stack in all at once in Japan and never bought again, right? And so I think, especially with this individual and asking this question, they're 34 and just getting started, like ideally you're going to be putting money to work every single time you have available money to invest. And so if the US market does have a correction in a big way, you're going to be accumulating, hopefully.
You should almost be happy.
Yeah, exactly. Right. Like you're going to be hopefully be buying at those levels, and it's the average price over time that really matters. So like, unless you just received a $10 million lottery win and need to allocate all of it today, I just don't think it's an impactful outcome over the long run, even if the markets do correct.
Yeah. Anyway, I think my Japan example just kind of shows that, like,
totally.
Yeah, U.S. market is very expensive in terms of its valuations relative to its own history, but that doesn't mean they can't go higher. And there's a non-zero chance that they go a lot higher, and you end up missing out on a bunch of returns. We can't predict the peak. We don't know when it's going to turn around or if it's going to turn around. So, I mean, the other possibility is that the fundamentals, like the earnings side of that equation of the Shiller Cape, grows so much that valuations aren't so high anymore, and we don't have a big crash. There are lots of different possible outcomes. I think people worry a lot about this, but probably not as concerning as people.
Or that could happen, and the Canadian dollar could drop more than USD, which offsets some of the losses too, right? Like you've got, if you're holding, US risks, like there's other potential sources of returns and risk there that can offset. Was it 20? I can't remember when it was, 2016 or something, 2015. I think US markets were flat, but USD was up 20%. So like you were up 20% just on the currency. So there's lots of stuff that can happen, right?
All right, should we do like 2 more questions?
Sure.
Sounds good.
Gotten to 18, so we definitely wouldn't have gotten through 161. There's no hope there.
I think we were like, we can probably get through half and like make it a 2-part episode. No, we got through like an 8th.
Well, I think what we can do is we can make a segment going forward. We can add a segment on like AMA questions, and we can just pull from this list until it's exhausted, and then maybe refresh it. I don't know. We'll see how long that lasts us.
Yep.
All right. What have been your most significant investment mistakes, and what valuable lessons did you learn from them? You guys want to go?
I've never made a mistake.
Nice.
Not surprised.
So, no, I'll take that one first. I would say that I was actually fortunate, just that the way my life unfolded was I didn't really have much money to invest until I had already learned about it. In other words, I didn't invest a lot of money when I was young, and then realized 20 years later that I was doing it all wrong. But I would say when I first started to learn about sensible investing, my biggest mistake was tinkering. So I was in pursuit of what's the optimal portfolio, and of course at that time, asset allocation ETFs didn't exist. So I was building my portfolio from individual ETFs, and I was like, I have to have 7.2% commodities, and I have to have, this, that. And I had, like a 10, 12 ETF portfolio with my $50,000 or whatever I had at the time. And, eventually I realized this is all a massive waste of time, energy, and money. And I needed to focus on simplicity, saving more, and sticking to a disciplined plan without, tinkering with it. And it took me a little while to get there, but once I did, I have found it very easy to stick to it because intellectually I know why it's the right thing. And also I happen to not have that gene. Like I've never bought an individual stock. I'm not interested in speculation of any kind. So that part's easy, but it did take me a while to get used to the idea that, you know, most of the tiny details don't matter as much as the big picture does.
Great answer.
Yep. Am I next?
Mark?
Yeah.
Triple leveraged Bitcoin.
Have either of you guys ever been margin called before?
No.
Okay. You've never really? Just me?
Nope.
Just me. Yeah. Um, so there was a period in my life where I was selling put options, cash secured puts. And without getting into a big explainer about it, basically you're making if you're selling a put, you are selling the obligation to purchase a stock at a certain price. And so let's just say you love Apple I'm just making up numbers. I don't even know what Apple trades for, but you love Apple at $100 a share. You sell a put at 80 and you collect a premium. So you collect $2 on that. And it's a 4-week contract, let's say. And as long as Apple doesn't go to 80 or below during that 4 weeks, you get to collect your $2 in premium and you move on to the next contract. If it does go to $80, you get exercised and you have to buy the stock at $80, which actually the narrative goes, that's a great thing, right? Because now you're buying a stock that you like anyway at a steep discount. What could go wrong? Well, the stocks can stay down for a very significant period of time. The stocks can blow through $80 and you're buying them at 80, but now they're trading at $50 and they stay there perpetually. And it's one thing if you're doing this cash secured, meaning in that example, you have the $80 available to actually buy the stock when it's assigned to you. So that would be the more intelligent way I would suggest to do something like this. But you can also do something called naked selling. In case you guys didn't know this, you can do that and not have the money. If it goes to $80 and you don't have the money to buy the stock in your account, then you can get margin called. And margin call means basically like you need to put more money in your account or we're liquidating you and you're going to lose a lot of money. So I've been through that, which is really fun for me. Not stressful at all. Thought I might lose my house and my family was going to disown me, but other than that, like came out of it okay. And here we are. So yeah, don't sell naked put options on stocks, especially if the market's going to crash. You'll have a bad time.
I've got
Pop that one, Ben.
I think I might have a worse one.
Oh yeah.
Uh-oh.
In two instances, people that I knew well enough who have had successful exits before, meaning that they started a company, raised money, and then either went public or otherwise sold and did quite well for themselves. We're raising capital for new businesses. And I knew these guys had exits in the past. I knew they were very financially successful. And because I knew them well enough, I guess they asked, hey, do you want to invest in this thing? We're doing this thing. They told me what the company was about. And this is years ago now. And I don't know, I felt like that was a kind of a cool thing to do. And I had a little bit more income that I'd had when I was younger, and I couldn't afford to do something like this. So I thought I think I'll do this. This is what smart people do. Both of them went to zero. Very unsuccessful. I don't know if it's, I guess, an angel investment type thing, but yeah, I don't want to describe the types of businesses they were, but yeah, I'm a very unsuccessful angel investor.
But without describing the type of businesses, would you say, is that kind of outcome bias in that, lots of businesses go to zero, not because they were terrible, but just because they were unsuccessful. And that's part of the risk of investing in, a startup, it doesn't necessarily mean you made a profound mistake based on the information you had at the time? Or was it more that just, I trusted these guys, I didn't even look at the business plan? Of
No,
course,
I looked at the business plan in
Mm.
both cases, and in one case, there was a, I don't know, I'd call it a company specific issue where they ended up going into another, or they raised money for one business, and then they were acquired by another business, and then there was a conflict between management of those two firms, and that caused enough issues that they had a lot of trouble. That company still exists, but they were, at one point they were listed. They've been delisted, and anyway, it's currently worth nothing. It might be worth something at some point, but still not a great outcome. So that was a very company specific issue, and then the other one was an industry issue where they were building a business in an industry that could have done very well, and that asset prices in that industry just completely tanked for a period of time while they were building their business, and that I think really decreased their ability to access capital. They ended up having to do another raise at some point, and there was just nothing there for them, and so they ended up folding for that reason. So two different reasons for the bad outcome. I think both were smart business ideas, and they were being run by groups of very, very smart people. But yeah, I mean, just goes to show you that there are a lot of things that can go wrong when you're investing in one thing, especially an early stage company.
I mean, the cool thing though is that you can put angel investor in your LinkedIn bio now, Ben.
Yeah, I could do that. Then people might ask me about my investments though.
True.
Unsuccessful angel investor.
Only talk about your winners. That's rule number one.
We do one more.
Yeah. There's two insurance questions here back to back. So I don't know if you want to just take both of them and then call it a day. What do you think?
Yeah, sure.
I'll read it. What are your thoughts on life insurance? Would you recommend a young Canadian couple with a new baby who have not yet maxed out TFSA, FHSA, and RRSP room, no RESP, to implement what we call infinite banking with life insurance? I already know your answer, but was hoping to understand your rationale on this. So, Ben, I know you've been working on something with respect to infinite banking. I've got my own thoughts on this as well, but I think, Ben, that's probably pretty fresh for you, what you think about infinite banking.
Yeah, sure. So infinite banking is the idea that you can buy a participating whole life policy, and you can overfund it. You can put more money in than is required to pay premiums. And those deposits, the cash value of the policy will then accrue participating policy dividends, which increases the overall cash value, and that compounds over time, which is great. And then you can borrow against your cash value from the insurance company. And the amount that you borrow, you pay interest on to the insurance company, and that interest goes back into the participating pool, which is why it's called infinite banking, because you're paying interest to yourself, is the way that it's sold. I don't think it's much more complicated than that, but that's the way that it's sold. So what would it make? Does it make sense to do that instead of invest in the registered accounts that this person mentioned? In the modeling that we've done on this, it is really, really hard for an insurance policy to come close to matching the expected outcome of any of those account types: TFSA, FHSA, RSP, and RESP. The reason being that the expected returns inside of an insurance policy tend to be relatively low. A participating life insurance policy can look a little bit better, but there's also risk in that case because the participating policy dividends are not necessarily going to be as high as they have been in the past or as they're currently illustrated at. So when you purchase one of these policies, it would be shown what's called an illustration, which is like a projection of the future, how the policy is going to look in the future. And that'll be based on the current dividend scale, which is like the participating policy rate, dividend rate that was most recently paid, I think. But it's always really important to ask to see those illustrations at current dividend scale -1% and current dividend scale -2%, because the current dividend scale is not guaranteed. And over the last 20 or so years, policy dividend rates have had decreased. They've actually come back up a little bit now, but it's not a guaranteed thing. And so the idea is everybody needs financing throughout their lives, and the best way to do it is through this. I don't think that's true. I think that you can invest in your registered accounts, which are tax preferred in various ways. The RESP, you get additional grants and bonds in some cases from the government, which make it really, really hard for an insurance policy to match it. And I mean, you can meet your financing needs with traditional means of financing, like taking a vehicle loan or leasing a vehicle instead of taking a policy loan. And I think that's a perfectly reasonable alternative. When you read the book, there's a book called Becoming Your Own Banker that's kind of the whole foundation of infinite banking as a concept. The thing that I found most striking about it, and this isn't the best way to argue against it, but I think it's important. The thing that I found most striking about it is that it's extremely ideological. Like, it's not so much about this is a really smart financial strategy and this is going to give you a better expected outcome. It's like, you don't want to pay interest to the bank. You want to pay it to yourself. And there's a lot more anti-government sort of almost conspiracy level language in that book. But I think that colors a lot of the logic of the strategy as a whole. But when you run the numbers, which we've done, which for a paper that I'm working on with Jason Pereira, it's really hard to make insurance match the expected outcome of investing in registered accounts. Anyway, so that paper's still a work in progress. Hopefully we'll do a more detailed explanation of our results. We've still got to work on a few modifications to the cases, but in general, I think the statement that it's difficult for a permanent insurance policy to match the expected outcome of investing in a registered account and accessing financing through traditional means, I think that's going to hold true in most cases.
Yeah, I mean, to step back and just not address the specific question about infinite banking, but looking at the first part of this listener's question, what would you recommend for a young Canadian couple with a new baby who have not yet maxed out registered accounts, et cetera, get cheap term life insurance? I mean, that has to be your number one consideration. Disaster proof your life, as Preet Banerjee used to put it in his book, because that's the idea, is that you've got to look after that before you start investing, right? Because that's if you procrastinate on the insurance until after you've maxed your registered accounts, you might never get there. And then, of course, the other encouraging part about all this, it's a lot easier to get cheap term insurance when if you're a young, healthy couple with a new baby than it is to start worrying about maxing registered accounts. So don't get fancy with this. Get cheap term insurance to cover all of the contingencies that you can imagine. And you can worry about these more advanced strategies later if they're really that important to you and if they really turn out to be advantageous, but it's not what you need right now.
Yeah, that's great.
Yeah, I think the other thing I'll say, and this is maybe some kind of logical fallacy, but I'll say it anyway, is of all of the great fee-only or fee-based financial planners I know, and I make that distinction because I mean, of all the great planners I know who are not purely insurance sales folks, I don't know a single one that has an infinite banking policy themselves, right? I don't have one. I don't have permanent insurance myself. I see no need for it. And I find it's very telling that the people who know about financial planning and not just insurance generally, and I'm sure there's people who are going to message saying that's not true and I have a policy, but I've never met somebody who does use infinite banking. And these are from people who could sell you infinite banking if it was optimal, but also are not biased towards it because it's not their only source of income. So I think that's a very telling point. And then, like, to your point, like TFSA, FHSA, RSP, RESP, like, you don't need to jump through hoops to use these accounts. They're right there for you. They're very easy to open. You can implement these in a low-cost way. For the most part, these are very, very liquid as well, and you're not locking yourself into any sort of long-term contract like you are kind of with whole life. Like, there's a lot of downside to the lack of flexibility that comes with these types of policies. And yes, the liquidity comes from you being able to borrow against it, but then you're just introducing interest rate risk to your plan as well, because if interest rates go up and dividends and paid up insurance amounts don't keep up, you can end up in a problem where you're starting to exceed the allowable level of cash value and interest in the policy. So there's a whole bunch of downside risks that I think in my experience, those who sell this type of stuff rarely talk about, like lower than expected dividends, interest rate risk, lack of liquidity, and being locked into something for a longer period of time. So yeah, there's very few circumstances where I think it's optimal. And as we've said all episodes, like the whole episode, do you know anybody that didn't meet their financial goals because they didn't implement infinite banking? No.
Yeah. I will say that it's not a totally insane strategy. Like in the modeling that we've done on it, it's not horrible. Like you're not necessarily throwing your money away. And it can work, I'm sure, for the right person. So if it's a strategy that really speaks to you for whatever reason, and it's going to allow you to be disciplined more so than you would otherwise, I mean, hey, that's fine, I guess. But I think it probably is suboptimal for most people most of the time. And I think it's really important. You mentioned it, Mark, that a permanent insurance policy is a contract that you're entering into, and breaking that contract, like if you decided to cancel the policy, it can be really expensive, especially early on. So those considerations are really important. Buying cheap term insurance for your life insurance needs and investing in your registered accounts is much more flexible. You don't have a contractual obligation. Now, a counter argument to that is that you don't have a contractual obligation. The insurance policy might encourage discipline, which for some people, maybe that's important. But I think that that philosophy, that strategy is generally oversold by people who are, in my experience, only insurance licensed. And if it works for some people, that's fine. But I think it would be wise for people who are being pitched that strategy to look for alternative perspectives, just to understand the potential downsides. Not that it's a terrible strategy that nobody should ever do, but I think you have to hear information about it from someone who's not biased to give you a certain view.
One more, last one.
Yeah, you can answer this one. I'll read it. You answer it.
Sure.
Mark.
Okay.
Parents bought whole life insurance for their child. The child is now an adult, 33 years old. Should the child take over the policy or do a cash surrender? What are the considerations? Or is there someone unbiased that we can recommend they talk to?
Mm-hmm. Yeah, so I actually got whole life quotes for my own two kids last year. I think there's a point where this becomes an interesting strategy, but this is they've already done it, right? So parents bought it for the child, and the child's now 33 years old. So one of the things that's really I think potentially attractive about this type of thing is that the policy can be transferred to the adult child. They can take over ownership of the policy, and that's not a taxable disposition necessarily. Oftentimes, if you were to transfer an insurance policy between like arm's length parties or between a corporation and an individual, it's a taxable disposition. But in the case where you're transferring it to children, I think as long as they're the ones who are insured under the policy, I want to say, going from memory there, then it's not a taxable disposition. So you're getting permanent life insurance for your kids at a very young age, which makes it relatively cost effective, ensures that they have some insurance in case, something happens health wise as they get older and they're young adults and they have some kind of health problems and wouldn't otherwise qualify. Well, at least you've got this insurance in place, and then you can transfer it to them and they can take over the policy, and that's not a taxable disposition. So, we can't say for certain because we don't have the full picture of why this insurance was purchased in the first place, what the, we don't know anything about their financial situation. What would they do with this policy if you were to transfer it? Would they keep it? Would they borrow against it? Would they cash it in? Are you concerned that they might do that and you want to hold it back and make sure that they don't have access to the money? We don't know. But it's certainly a consideration. And I think in the right case, assuming that child who's the life insured has reached some kind of financial maturity, and if there's still premium payments required, they can take over the premium payments. I think it's totally reasonable to transfer it to them. But this was ideally bought under some kind of goal or plan. So I'd be curious to know why they bought it in the first place, and if it makes sense to transfer it to them. Tons of great insurance advisors out here. I won't name drop on this episode, but this is a question from Alexis. So Alexis, if you're listening, feel free to reach out to me on LinkedIn or Twitter. Just send me an email and I can give you some recommendations to unbiased advisors that you can talk to about that. Dan, I don't know if you've got much experience in these types of policies, but
No, I mean, to your comment about this was obviously done with some kind of long-term plan. I mean, maybe,
right.
or maybe the policy was just sold to them inappropriately. I mean, who knows? I mean, and
Never happens.
insurance is one of those things too that the answer is virtually always it depends, in the sense that the 33-year-old in question here, I mean, what's their situation now? Do they need permanent life insurance? What's their health like? Right? I mean, obviously, if you've had a diagnosis in the past, or you find yourself more or less uninsurable, of course you should take the policy, take it over, and continue it. If you don't need permanent insurance and you're in a situation in your life where it might make sense to take the cash surrender value, get cheap term insurance, do something productive with the cash surrender value, that's important too.
Hmm.
There's lots of possible answers here that we can't possibly know without understanding the circumstances. But
Yeah, agreed. And one thing maybe to consider is that to surrender the policy and withdraw the cash value could be taxable as well. Basically, the cash value of the policy minus its adjusted cost base. And if the policy's been in force that long, it's likely the adjusted cost base is relatively low, and we don't know how big this particular policy is. But the excess of the cash value minus the adjusted cost basis is taxable when you withdraw it, and it's taxed as income, not a capital gain. So surrendering it could be a tax event that they aren't aware of or weren't prepared for. So something to keep in mind.
We've got through 20 questions. We'll save the other 141 for future episodes.
How long have we been recording for? What time? Almost 2 hours. Oh,
2 hours.
Almost 2 hours.
Oof. 20 questions in 2 hours. How many did we get? 160?
161 in total.
Oh man. So this is 16 hours to get through all of these questions if we were to sit down and do them one by one.
Yeah. I bet if we made one episode that long, people would actually listen to it though. That's the crazy thing.
Yeah.
We could do a whole episode about your hair.
Yeah, almost. Yeah.
I don't know about a whole episode.
Maybe half an episode.
Maybe half an episode.
All right.
Okay, should we go to the after show? We have a couple of reviews.
Sure.
So we got one from Grouty11 from Great Britain. They say, I listened to the end and I hate the show. 5-star review though. I think it's a play on Mark and I talking about how if you're listening to the end and hate the show, that's on you. So they clearly were listening to the end and hate the show, but gave us 5 stars, which that's great. It's probably
and are no doubt listening to the end of this show as well.
Yeah, yeah.
Of course.
Yeah.
Who wants to do the next one?
I'm just bringing it up right now. I was working in a different file, so if you've got it up in front of you, go ahead and read it.
I can do it. It references your beard, so you probably shouldn't read it anyway.
Nice.
So this one, insightful, funny, and factual. They say, truly one of the best podcasts I've listened to. Cannot think of a better one to recommend. The quality of content is incredible, and it is presented in an enjoyable manner. Over the years, this podcast and the community have had a significant and positive impact on my financial position and ambitions. A big thank you to the entire team. Finally, I want to express how amazing Mark's beard truly is. One of a kind, if only the other hosts could keep up.
The latter part is true. I don't foresee you guys keeping up, but I wouldn't call this is, there's not much to it really.
I couldn't grow a beard like that if I tried, for sure.
Really?
I couldn't either.
I take it for granted, eh? I got hair, like my hair grows like almost up to underneath my eyes. So I have to shave like here. And like if you look close enough, it kind of connects to the eyebrows on the side. And I got to pluck in the middle too. So it's like literally goes like all the way around. And so it's like the bane of my existence. But to those who can't grow a beard, they're like, oh man, that's sick. Like you can grow a great beard. I'm like, I don't think you understand how much work it is just to not look ridiculous every day. Maybe I do look ridiculous every day. I don't know.
But
thank you.
Great. I have no hope of growing a beard like that. It's super patchy. I did during COVID. I grew it because I don't know. COVID was crazy.
$20.
So
Yeah.
I shave it myself. I never paid anyone to shave my beard. The hair thing was never about saving the $20. It was just about the hassle of getting change. And I don't know, man. I didn't mind paying. If I could have used a credit card, I would have kept going. To your point, it was just the change situation just was killing me.
Right.
Yeah. Have you guys seen me with a bigger beard? Have I ever showed you pictures? I've had a beard
pictures.
like a proper like solid beard before. I should maybe
before you came here, before you started with PWL, your Twitter picture was you with that gigantic beard.
And you hired him anyway?
Oh, it's been bigger. It's been bigger than that actually.
Oh, yeah?
I should grow it back out. Yeah, it's been like there's been some heft to it back in the day. But I get this, you can tell here, but it's gray here, and it's like a racing stripe that goes right down the center, like ZZ Top kind of thing. And I think it looks weird, but I don't know. Maybe I'll bring it back. People like it.
Wait for the playoffs.
There you go. I'm a Vancouver fan though, so it's like you never know.
So there won't be any playoffs.
That's the problem, right?
All right, since this is our year-end episode, do we have last episode of the year, I guess, right? Yeah, it is. Do we have parting words? Anything that you guys can think of to say to our audience before we end the year?
Yeah, I mean, it's been, I don't get to engage with the audience probably as much as you do, Ben, because I know you spend a lot of time in the community, but I do hear from a lot of people online who reach out directly to me and are super appreciative of the show. So for me, it's been, I mean, just like an honor and a pleasure, and honestly still kind of pinching myself that I'm here co-hosting this podcast that's been so influential in my life. So yeah, big thank you to
with Dan too.
Yeah, well, I know
on this podcast with Dan,
with the couch potato too. Like that's ridiculous. Yeah, so I'm just super grateful to be here, and obviously this opportunity exists because you guys did such a great job with it for the first many years and have built such an incredible community of people and listeners. So just thanks to everybody who's involved in the production and getting it out, and thanks to all the listeners for sticking by and putting up with me over the past few months as well.
Yeah, I would echo that as well. I mean, as I know you guys know, I was just kind of sunsetting my own podcast when Rational Reminder took off. And, you know, you guys have had just incredible longevity. And I know how difficult it was to just crank out an episode every month or two. To be able to do what you do every week for as many years as you've done it has been amazing. And it's been a great opportunity for me to kind of get on board and feel like, you know, back as part of the community again and generating the kind of content that PWL has been, you know, well known for. So nice to be back in the seat.
Yeah, it's awesome having you guys here. I think that's it. I mean, yeah, thanks to everyone for listening, and we'll be back in a week. We're not taking any time off. The podcast isn't. We will. We pre-recorded episodes though, so there will be an episode coming out. But I don't know about you guys. I'm probably going to take a little bit of time to relax over the holidays.
Yep. I'm going to Mexico. My wife and kids are there right now.
Mexico.
And,
oh, nice.
I'll be joining them for a couple of weeks.
Nice.
Excellent.
You doing anything, Dan?
All right. Sorry, was that for me?
Yeah, I just said, are you doing anything for the?
Oh,
for the holidays?
no, I'm not going away. I might take a few days off, but no, staying close to home this year.
Good for you.
Yep. Me too. There's a ski hill, small ski hill, not like where you live, Mark, but there's a small ski hill where I live, and my kids enjoy that. So last couple of years we've stuck around here and just kind of hung out, but it's nice that things slow down around the holidays, even if you don't take time off. Like I could still come to my office and do work, but there's like nothing else happening.
Yeah, clients tend to be pretty quiet around the holidays. They got better things to worry about. So
yeah, exactly.
And especially this year, it's been such a good year.
Yeah,
you know, for Mark, I'd say there's a little bit less anxiety than there has been in the past.
Yeah.
So.
All right. Well, we'll leave it there. So yeah, we appreciate everyone listening throughout the year, and we'll see you in the new year. Enjoy the holidays.
All the best.